Welcome back. Oil prices and coronavirus. Crude oil prices sliding to their lowest level in 17 years amid this outbreak. The industry facing dwindling demand for oil as global travel and airlines are seeing businesses stall and come to a stop. Joining me right now, the Schork Report publisher, Stephen Schork. Stephen, we've talked about oil prices in the past. I know you were not expecting $25 a barrel. This came at us as a surprise. What's your reaction to all of this?
Well, Marie, it's Groundhog Day. This is 9/11, Desert Storm, Hurricane Katrina, rolled up one, and we're waking up to it every single day. So we're clearly in uncharted waters, and this is why we at Schork made the executive decision yesterday to make our research available free to all market participants until we get through this situation. Now, let's paint the picture. And you're right. A month ago, when we looked at oil prices, the United States was at record crude oil production, record crude oil exports. In fact, since October, when we look at net exports of crude oil and petroleum products, the United States has been a net exporter of oil since October at approximately 150,000 barrels a day. Now, this situation and the refusal of U.S. oil production to pull back, because all indications was this supply was going to increase through the summer, was the antecedent to the price war between Saudi Arabia and Russia. After all, why would Russia cut its production when the U.S., which, by the way, just sanctioned last month Russia's largest oil trading company, why would Russia pull back their production and lose market share to the United States? So now you have the double whammy. You have increased supply, not only by the United States now, but also Saudi has now ramped up its output, and so will Russia. Now you juxtapose that with the pandemic and the fall in demand, and when we look at the term structure, nearby prices have absolutely collapsed. So demand is falling, and the market is telling us it expects demand to fall precipitously over the next few months. So it's an extremely dire situation in the oil markets right now.
Well, I mean, it's a dire situation, and I don't think it's any coincidence. I mean, here we are facing a crisis, so what does Russia do? Comes in and says, look, we are not going to agree to any cuts, and that sends oil prices lower. But do these players, Saudi and Russia, understand that they're hurting their own businesses as well by pushing prices to $25 a barrel?
Well, absolutely. But it's reported that both of these countries have more than $500 billion sitting in their foreign asset reserves. And when we look at Saudi Arabia, its debt to GDP ratio is maybe 25%. So both countries do have the wherewithal to get through this. Who does not have the wherewithal, Maria, to get through this are the smaller shale producers here in the United States. So we are in the midst of a bloodletting in this market that we have never seen before.
Again, Michael Lee, jump in here. This is what we were expecting. Hey. Russia wants to put these shale producers out of business.
Steve, just the flip side of this, when will consumers see this in gas prices? I mean, we've seen like a 40% decline, 50% decline in the price of oil. Are we going to see that at the pump when we go to fill up our cars?
Oh, absolutely, Mike, and we'll start to see that over the next couple of months. We're looking at a national average now, which was right around $2.42 a gallon. We're well on our way on a national average of seeing sub $2 gas. So there are going to be certain market areas in your low-tax states like Texas and Virginia where you'll see prices well below $2. And, Mike, we have to keep in mind that come May, come June, refineries and terminals have to have a summer-grade gasoline in their tanks, and retailers need to have that on in their tanks on June 1st. So we're at that DY over DX moment when we transition to summer-grade gasoline, keeping in mind that summer-grade gasoline is harder, more expensive to manufacture. And when you juxtapose that with the normal demand we see in the summer, you do have higher prices. That higher price, that seasonal uptick in gasoline prices, not going to happen this year, obviously, with oil at $25. And look, Maria, you said it before, like our models, when we run our Monte Carlo simulations for Schork, we were looking at worst-case scenario this month, oil in the low 30s. Obviously, we're now beyond the third standard deviation in the mid-20s. We could go considerably lower even at this level.
You think we can go considerably lower even at this level? Wow. All right. Stephen, thank you.
Absolutely. Yeah. I'm
Very important part of this story. Stephen Schork, we'll be watching. Thank you so much, sir.